You're about to hear a tremendous interview with legendary Felix Zulauf. But first, this segment is sponsored by Caden Resources, which is one of the best positioned junior resource companies in the entire industry. Having recently sold a property to Goldcorp, the company is preparing to embark on a massive drill program at its high-grade property in Mexico, which has a very high probability of becoming one of the highest-grade gold projects in all of Mexico. This management and exploration team is the same group that found over 5 million ounces of gold at their last project. Caden Resources, symbol CYD in Canada and CDKNF in the U.S. This is King World News. I'm Eric King. Remember to go to our homepage where we've already had Michael Pinto and Dr. Philippa Malmgren. But without any further delay, here is Felix Zulauf. Joining us now is world-renowned money manager Felix Zulauf, who has been a Barron's Roundtable panelist for over 20 years. Felix, there's so much I want to talk to you about today. What's ahead in 2014? Government theft, gold, China, Europe, United States. But with all that's happening around the world, I think there's some confusion. You wanted to address this, the way the world functions. Let's start with that.
Well, the biggest problem of the world economy is that there is not enough demand out there, and there is more supply. And somehow the world economy doesn't grow at the pace the governments would like to see it growing to get working down on their structural problems, et cetera, et cetera. And therefore, we have started a competitive devaluation race. Usually the U.S. starts with it, and the last 10 years the U.S. dollar went down. And that triggered all sorts of carry trades, particularly when QE started after the great financial crisis, or in the midst of the great financial crisis. And that triggered capital flows into other parts of the world and triggered misallocations there, et cetera, et cetera. And what people don't understand is in the old days when you had the gold standard and Bretton Woods fixed exchange rate system, a government could just declare overnight that tomorrow our currency has devalued against the price of gold by 20% or 30% and has therefore devalued against the U.S. dollar by that percentage, et cetera, et cetera. That was easy. There was no cost, and the effect for liquidity in the global financial system was virtually zero. The balance sheet of that particular central bank gained somewhat because of the revaluation of gold and some revaluation of foreign exchange reserves, of course, and that was it. Today, you cannot declare that. You cannot say, we want our currency to devalue overnight by 20%. You have to take action to get your currency down. And the action to get your currency down is really a quantitative easing or printing money. And that's what's been going on. And the U.S. has been particularly good at it. They have done it and they have experience since the late 1960s, actually. And they create problems for all the others who are big exporting economies and exporting nations because they make their currencies being revalued. And so we are in a world of competitive devaluation, and somebody called it a currency war or whatever, but that's what's going on. And so we have had the U.S. going ahead. We are now starting to see the Chinese, who have major problems in their economy because, as you know, it's been the biggest investment boom and credit boom in modern history in the last couple of years in China, and that has come to an end because it's overinvestment, malinvestment, et cetera, with all the fallouts that are coming for the future. And the way China can come out of this is either they have to deflate their own economy, which hurts dramatically and creates all sorts of social problems, or they can devalue their currency and regain some export competitiveness and flood the world economy with their goods. And when any government that has to decide which way to go decides to go the route of devaluing the currency, of course, and that's also for the Chinese. The Chinese have done a spectacular marketing job making the world believe that they have everything under control and everything they do is well prepared and well thought out, and et cetera, et cetera. All they have done is they have prepared the background and the red carpet for the currency devaluation by saying we internationalize our currency, we broaden the ranges, and eventually we liberalize. That's just much nicer put than saying we are going to devalue our currency. Because if they want to stabilize or prevent their economy from going down the drain, they have to provide liquidity after the big boom that we have had to fight the deflationary forces. And that liquidity will make the currency go down. So be prepared for the next few years for the Chinese renminbi to continue to decline in currency markets. And this, of course, has an important effect. It is one of the largest export nations in the world, probably the largest one, if I'm not mistaken. And when the largest exporter of the world begins to devalue its currency, and I'm not talking about 2 or 3%, I'm talking about 10, 20, maybe even more percent over the next few years, then, of course, this has repercussions for all the competitors in the world, and there are many, and particularly for the emerging world that is competing directly with the Chinese. So this creates more and more deflationary pressure, and this may be good for the Chinese economy, but it's virtually bad for everybody else. It's very similar to the effects that we have seen coming out when the Japanese decided to devalue the yen in late 2012, and the yen declined by virtually 30%. And that was triggering off all sorts of problems in the Asian emerging countries, as you may recall. And I think China is Japan by a factor of 10, probably, in terms of its impact, because the Chinese have domestic production, whereas the Japanese have international production. And therefore, I think this is going to be with us for the next few years, and it will make sure that inflation, as we measure it in terms of consumer price index, will not go up a lot. It can't, because when the biggest exporter of the world devalues its currency and import prices in other economies therefore fall as a result, that keeps inflation rates very low, despite all the money printing that's going on in the world. I think that's an important message to investors, that interest rates and CPI inflation will remain low, and the deflationary pressure there is in the world economy will remain with us and probably re-intensify at some point of time. I mention this because the consensus thinking is right now looking completely in another direction. They are talking about normalization, they are talking about recovery in Europe, they are talking about reflating Japan and growth coming back in Japan, etc., etc. And based on that consensus assumption, there are corporate profits and earnings for stocks being built into the valuations, which may be negatively affected over time.
You spent a lot of time on China there, Felix, and I'm just curious your thoughts on the really unprecedented demand we've seen out of China. The amount of gold they're taking into that country is astounding. Can you talk about that?
Well, obviously, unlike many other nations, the Chinese government has encouraged citizens to put part of your savings into gold. And they know very well how fiat currency system functions. And making the renminbi a fiat currency, they know that it will lose value over time, and that gold will do much better in the long run. And I think the clever Chinese, they have diversified the part of their money into gold. So far, it hasn't worked for them, and gold has declined. And it tells you that the deflationary pressure in the world economy is just too big for gold to go up. And so far, we haven't had another systemic problem that would make investors move into gold because of the systemic risks. That will come back, of course. My view on gold, I have been lukewarm on gold for a while. I hold a lot of physical gold. I hedge it and I work against it in the futures markets. And I'm still net short. I hold my physical positions, but I'm short more in the futures markets because I see the bottom coming up sometimes this summer. And we had two important lows around 1180. One was in early mid-13, and the other one was in December, January of this year, around 1180. And so it may be a double bottom. We have medium-term indicators that tell me the price trend is down. So we may have a triple bottom. That would be the positive outcome. The negative outcome would be a breaking of the 1180 level for a final washout. And that could then immediately go to 1050 because it would trigger a lot of stop-loss selling. But that would be the washout and would be a marvelous opportunity to pick up gold at very cheap prices. So I think all this should happen within the next 3 to 4 months or so. I'm looking for a better trend in gold in the second half of this year and particularly next year, when I think the world will learn that the systemic problems have not gone away and maybe they have grown even bigger.
Let me ask you this, Felix. When you go back and you look at the 25 roughly fold move that we saw in gold in the 70s, obviously from 250, that would put us at $6,250 gold. But I'm just curious where you see gold headed over the long term.
I wished I knew. I really don't. Currency systems, and that's important because gold is money, and it's true money. It's money that is not part of a balance sheet of a central bank in that sense, and it doesn't have any debt, et cetera, et cetera. It is a real asset. It has been money for thousands of years and will remain so. Paper money is different. Gold has survived all paper currencies. And all fiat currency systems, as we are in since 1971, have eventually collapsed. That's the long term. I do not know when our paper currency system will collapse, but eventually it will. And that's where the true value of gold will be, because in gold you can store your savings and your assets in a better way than in paper currencies. Of course, other assets can fulfill the same function. Real assets to some degree, stocks, good companies that survive serious crises, systemic crises, etc., etc. In the end of a fiat currency system, you either have a deflationary collapse and a currency reform, or you have an inflationary collapse and the currency reform, and you cut out a lot of debt. And obviously, you also cut out a lot of assets and wealth. That will be the ultimate point where gold really is the most important asset to hold.
You said earlier China is Japan by a factor of 10. How bad will this get, this bumpy patch that's in front of us?
Well, China has been extremely successful, but they have overdone it, and they are in a down cycle. It was funny the other day, I think it was just April 1, April Fool's Day, or April 2nd, they came out publishing the GDP numbers of 7.4% or what it was for the first quarter. Think about it, an economy of 1.3 billion people publishing GDP one day after the quarter is over. I mean, that's a fabricated number. You cannot take that serious, of course. Of course, many other numbers in the Western world are also fabricated. Just think about CPI. But that's a fabricated number. The Chinese economy is slowing down, and it's slowing down because the investment and credit boom is over. And usually after such a tremendous boom we have had for so many years and so many excesses, you do not slow down for 2 quarters. This is a slowdown that will last a few more years. And China could be in a crisis, but they will manage through that crisis. They have the means to do that. They will print a lot of liquidity to do that, and therefore they will devalue the currency. And they come out of it eventually quite strong again. But what's important for the world is that China is in a down cycle. It used to be the growth engine, the locomotive, the demand generator for goods and services for the rest of the world. It no longer is. It is slowing down and will continue to. And that is very important. Then on the other side, you have the U.S. The U.S. is doing relatively well. The U.S. Probably has a natural growth rate based on demographics of about 2.5% or so. And it may grow at 2.5%, maybe at 3% in some quarters, maybe even a little bit more. But the trend growth is probably 2.5%. The U.S. is the largest net importer of the world. And what you see is that the external balances of the U.S. are constantly improving. They are importing less and less, partly energy, but also partly industrial goods. And that means that the surplus nations are losing exports because of the U.S. losing less growth to the world, to the rest of the world. And that means the U.S., in a relative position speaking, is much better off than the rest of the world that depends on exports. And I'm talking about successful nations, export nations like Germany or like China was. And therefore they have to go for competitive devaluation to regain their competitiveness, or trying to.
Felix, I know you've had a good hard look at what happened in the 70s, and even though what we're going through today is unprecedented, and we talked about that prior to the interview, is it going to be much worse than what we saw in 79, 80? Because that was total panic as that crescendoed, and it does seem like the world's problems are much worse than they were back in the 70s. Is it going to be worse this time as we crescendo at the end of the cycle?
It's completely different. In the late 70s, we had a big inflation problem. We had much more demand than supply. And not just in goods and services, but also in labor. And therefore it was a highly inflationary world which was fed by the central banks not knowing what they were doing because it was new. They came all out of a fixed exchange rate and gold standard system and didn't know exactly what their behavior would result to. And once they realized it, they changed, and they started to constrain the supply of money, etc., etc. Paul Walker was doing it in the U.S. Frank Leutwiler was doing it in Switzerland. He was the first even, and Pearl was doing it at the Bundesbank. The problem today is completely different. We don't have too strong demand in the world. We have just the opposite. We have too much supply and not enough demand. And we have much worse demographics in a way. And we also have a distribution of income that is much more uneven. So the way things are going in the developed world is that less and less people are well off. You have economic growth, but you have income distribution that is very uneven, and you have more and more people having a very, very tough time to making to the end of the month. And that was different in the 1970s. And so we have much more a deflationary problem as the root cause in our world economy and in our system than an inflationary problem like in the 70s. And of course, they have been trying to overcome this by fiscal stimulus, by governments going into the debt and providing demand. And the result is that the share of government is growing in many of the economies. And that makes productivity and efficiency go down. And because of that, and because things are not working out the way the governments want, they introduce more and more rules and regulations, which makes efficiency and productivity go even further down, and it hurts prosperity for the average citizen. That's why politics is moving more and more into populism. And you have one quick fix after the other instead of really addressing the root cause of the problem. And I think we are stuck in that, and we are trapped, and we are not coming out, and we see competitive devaluation where one after all of them cannot devalue at the same time and think they can get out of it. That doesn't work. So it's one after the other who tries to regain competitiveness by devaluing. So it's a downward circle in the paper currency, so to speak. But it doesn't bring us any forward. At the end game, you will probably have capital controls. We have capital controls in several of the economies. You have capital controls in Russia. You have capital controls in Argentina. You have it to some degree in Brazil, in Portugal. At the end of the day, I think we will end up in capital controls. And what we are working at without knowing is that we not only decelerate globalization, we really reverse globalization. So globalization is now running backwards, and we go into regionalization. And globalization for some time created more and more prosperity because it created cheaper and cheaper goods. If it's now running backwards, it's the other way. And what you have is you have a systemic problem that is very, very difficult to solve. I do not know any way out except that you reduce government, you reduce rules and regulation, you make more room for free markets, competition, and you let the markets work it out. And then you may have a big downturn and some serious problems for a while, but at the end of the day, you have a clean situation and you reintroduce prosperity and the prospects for longer-term growth.
Will the key to this, as you warned many, many years ago, to be outside the banking system?
Oh, absolutely. You know, the banks are the worst money managers of this world. And I don't blame them because they are the receivers and the transmission mechanism for all the money being printed by the central banks. So they are flooded with cheap or gratis money, so to speak, and they have to do something with that money. So they go into carry trades. You can look back in the history. It started with Citicorp being trapped in Mexico or whatever. It goes on and on and on, and they are in carry trades again. And when you look at the quality spreads between junk bonds and treasuries, we are back to the extremes of 2007 at the last cycle peak. We have many other extremes that suggest we have tremendous speculation in the system, all thanks to printing money and creating a sea of liquidity that is being used for carry trades much more than being activated and creating demand in the real economy. And Janet Yellen doesn't understand that. You know, she thinks she can improve the employment situation by printing money like mad. That's nonsense. She is worse than Greenspan and Bernanke together. So eventually, this will turn out to be very good for gold, very bad for paper currencies, very bad for bonds, but this will take a while. I think bonds are okay for the next 12 months, probably not for the next 3 months, but for the next 12 months. And in the long run, I think stocks is also a mean where you can store some value, but you have to prepare that you lose 50% for a while before they go up again.
Felix, I said that was the last question, but any major surprise in 2014 that's still in front of us?
I think the world will be surprised that the Chinese currency will devalue by much more than the world was expecting, and that eventually the world could wake up understanding that this is no good for the world.
Felix Zulauf, Barron's Roundtable panelist for over 20 years, world-renowned money manager. Thank you for joining us on King World News.
Thank you for having me, Eric.
Be sure to tune in as we will continue to release interviews with the top people in the world throughout the week. Also, make sure to check out the King World News blog.